How are current geopolitical tensions reshaping the landscape of foreign investments in China? This is the question we will be exploring today. It is an historic event as China foreign investment gauge turns negative for first time. Before we dive in details, please subscribe to the channel and stay always one step ahead to know all global important events happening around you. Give a thumbs up and share the video with your family and friends. Let's move on with the video. A measure of foreign investment into China turned negative for the first time since records began in 1998, highlighting how foreign companies are pulling money out of the country due to geopolitical tensions and higher interest rates elsewhere. China's direct investment liabilities in its balance of payments declined by $11.8 billion in the third quarter, the country's Foreign Exchange Administration said. The measure records monetary flows connected to foreign-owned entities in China. Economists have said the decline in FDI by the balance of payments measure reflects less willingness by foreign companies to reinvest profits made in China in the country. That's due to strained ties with the West and the rising attractiveness of keeping cash overseas. Advanced economies have been raising interest rates while China has been cutting them to stimulate the economy. Probably this reflects foreign firms repatriating earnings from China, whereas previously they reinvested them, said Duncan Wrigley, chief China economist at Pantheon Macroeconomics. International firms, especially US ones, have been reconfiguring supply chains to use alternatives to China. China's other main measure of foreign direct investment inflows, released by the Commerce Ministry, reached 920 billion yuan, $125.8 billion, in the first 3 quarters of this year, down 8.4% compared with the same period in 2022. That measure is impacted by the decline in the Chinese currency's value relative to the US dollar this year. Foreign companies in China operating in export-oriented and industrial sectors have seen their profits fall this year, as the value of China's exports has declined and a property slump hit demand for industrial goods. Foreign invested industrial companies' profits in China fell by 10.5% in the first 3 quarters of 2023 compared to the same period last year, according to China's Statistics Bureau. The balance of payments data could mean there are more divestments than new investments, said Michelle Lam, Greater China economist at Société Générale SA. That's quite concerning. I think it's just continued diversification of supply chains. Confidence will take time to recover following the more supportive measures. China sees investment by international companies as key to upgrading its economy and has stepped up efforts to woo foreign investors this year. Top officials have given assurances to overseas chief executives, and government departments had meetings with global companies to ask for policy suggestions. China's President Xi Jinping met with Microsoft Corp. Co-founder Bill Gates in Beijing in June. Overseas business lobby groups in China have called for concrete actions to address their concerns, which range from local protectionism to an unpredictable regulatory environment and crackdowns based on national security concerns. China's Premier Li Qiang has a good track record on foreign investment, having securing Tesla's investment in Shanghai, and is likely to be proactive in seeking foreign investment, Wrigley added. But he faces a tough challenge, given the tepid outlook for China's consumption recovery and geopolitical tensions. As well as FDI, foreign portfolio investment in Chinese companies has been weak this year, due to concerns about economic growth and better returns elsewhere. Foreign funds sold 172 billion yuan worth of mainland shares in the 3 months ending October. That threatens to turn this year's foreign flows negative for the first time since China opened a second mainland Hong Kong stock trading link in late 2016. Foreign institutional investor holdings of bonds in China's interbank market fell from a record 4 trillion yuan in 2021 to 3.19 trillion yuan at the end of September, according to data released by China's central bank. Detailed data on portfolio investment and other investment are not released yet, but these two channels likely still showed outflows in Q3 as foreigners net sold RMB assets in the quarter. Economists at Goldman Sachs Group Inc., led by Maggie Wei, wrote in a note, "Capital outflow pressures may persist in light of the unfavorable interest rate differentials. As these businesses took on more and more debt, the risk associated with investing in them increased." This was especially true for companies in sectors like real estate and technology, which had been the darlings of foreign investors. The turning point, however, came when foreign companies started to act on their concerns. They began pulling out their investments, a move that sent ripples through China's financial markets. This wasn't a sudden exodus, but rather a gradual retreat. The pace, however, has been quickening, with more companies joining the outbound tide. This mass withdrawal of foreign investments has had profound implications. It has not only affected the companies that have left, but also the Chinese economy as a whole. The exodus has led to a decrease in foreign capital, which has been instrumental in fueling China's economic growth. With companies pulling out, China's economic landscape began to shift dramatically. This shift, as we will see, has far-reaching consequences, not just for China, but for the global economy as well. But that's a story for the next scene. Stay tuned. Opening. What are the repercussions of this massive withdrawal of foreign investments? As we delve into the aftermath, it's clear that the economic landscape of China is being reshaped. The most immediate impact: Chinese companies, already burdened with significant debt, are feeling the squeeze. Without foreign capital to rely on, many of these companies are finding themselves in dire straits. The struggle to service their debts is real and palpable. Some are even teetering on the brink of bankruptcy. This is not just a crisis confined within corporate walls, it's a crisis that spills onto the streets, affecting millions of Chinese citizens. Jobs are at risk as companies scramble to cut costs. The public, understandably, is reacting with concern and, in some instances, outright anger. Protests have broken out in several cities, a clear sign of the public's growing dissatisfaction. But the fallout doesn't stop at China's borders. The global markets are also feeling the tremors of this seismic shift. With China being the world's second-largest economy, a shakeup of this magnitude sends ripples across the financial world. Investors worldwide are nervously watching their portfolios, bracing for potential losses. Meanwhile, other nations' markets are seeing an influx of capital as investors seek safer havens, leading to a shift in economic power dynamics. This massive withdrawal of foreign investments has also put pressure on the Chinese yuan. The currency has been on a roller coaster ride, fluctuating wildly as investors pull out. This instability can deter future foreign investments, further compounding the problem. In the grand scheme of things, this exodus underlines the interconnectedness of our global economy. It highlights just how much the fortunes of one nation can impact the rest of the world. Closing. The fallout from this exodus is far-reaching and still unfolding. How has the Chinese government responded to these changes? That's the question on everyone's mind as the global investment landscape shifts. The Chinese government has not sat idle amidst these alterations. Instead, they have proactively taken steps to reassure investors and stimulate their economy. In a bid to calm investor nerves, the Chinese state has been vocal about the attractiveness of yuan-denominated assets. They've argued that short-term market panic does not accurately reflect long-term value. This perspective has been underlined by the best day in 2 months for China stocks, with the CSI 300 index and Shanghai Composite Index both posting gains. The message? Don't overinterpret regulatory actions or get swept up in temporary market turbulence, but the government's response has extended beyond mere words. They've actively engaged with the global financial community. This has included holding meetings with executives from top global investment banks to address concerns and assure stability in the markets. The securities regulator has clarified that recent regulatory actions were aimed at isolating specific industries, not decoupling Sino-US financial markets. In an attempt to stimulate the economy, Beijing has implemented measures that have attracted foreign investors back to China's stock and bond markets. After months of antivirus restrictions and global political tensions, foreign investors have started to see China as an attractive market again. The end of the virus lockdown in Shanghai and the easing of restrictions in Beijing have contributed to this positive sentiment. An important part of the government's strategy has been to reassure investors that it remains supportive of domestic companies seeking to list overseas. They've promised to unveil more measures to open the capital market to foreign entities. This is a clear sign that they want to maintain the international relevance and attractiveness of their markets. The Chinese government is making moves to regain investor confidence, but is it enough? Only time will tell if these measures will be sufficient to stem the tide of foreign investment leaving China. But for now, the government seems determined to show that China remains a viable and attractive market for foreign capital. Where do we go from here? That's the million-dollar question. After unpacking the geopolitical tensions, the exodus of foreign investments, and the fallout, we're left wondering about the future of foreign investments in China. Will the government's efforts to calm investor nerves and assure market stability prove successful? Or will foreign investors continue moving their assets elsewhere, lured by higher interest rates and less volatile markets? Despite the current uncertainties, there are a few glimmers of hope. For instance, the easing of COVID-19 restrictions and lower stock valuations have made China an attractive market for some investors. Furthermore, Beijing has expressed its support for domestic companies seeking to list overseas and plans to unveil more measures to open the capital market to foreign entities. However, these positive factors must be balanced against the ever-present geopolitical tensions and China's economic challenges. The fear of Western sanctions against China could resurface, and the high debt levels of Chinese companies remain a concern. Only time will tell if these measures will restore investor confidence or if the exodus of foreign investments from China will continue.